In today's episode of the Daily Brief, I'll talk about two stories. I first talk about how houses around the world are becoming impossible to afford. I then discuss how the OPEC is finding it super hard in navigating the world of crude market. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today's Friday, the 13th. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi, and if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the show notes. So let's start. In the first story, I'll dive into what's being called the worst housing affordability crisis in over a decade. From London to Mumbai, housing markets are at an interesting juncture. So let me break down what's happening globally and here at home in India. The reason I'm talking about housing is because the IMF, in its Finance and Development magazine, published a series of interesting perspectives on housing markets around the world. They were quite interesting, and so I thought I'd just summarize them for you. Let's start with the big picture. Housing isn't just about having a roof over your head. It's the biggest source of both wealth and debt for most people. It's central to economic stability and represents stability, security, and a sense of belonging. But right now, that dream is slipping away for many, particularly young people. The numbers are stark. According to new research from the IMF, housing is less affordable today than during the bubble that led to the 2008 financial crisis. The crunch has hit the hardest in the United States, United Kingdom, Australia, Canada, Germany, Portugal, and Switzerland. In the US, housing affordability has plunged from 150 on the Affordability Index in 2021 to mid-80s by 2024. The UK saw a similar drop from 105 to the lows of 70s. The IMF articles and research didn't have much on India, but I'll get to that later. What makes this crisis fascinating is the psychological element driving it. It's not just about interest rates. Those only account for about a quarter of affordability changes over the past 50 years. What's really pushing prices up is human behavior. The fear of missing out, combined with social narratives about ever-increasing prices. This creates a powerful cycle that keeps driving the markets even higher. This generational divide is stark. While their parents' generation rode a wave of housing appreciation since the 1980s that made them among the world's wealthiest through home equity, today's young people face a very different reality. They're not just struggling to buy, many can't even afford to rent. So what's driving this crisis? Well, it's a perfect storm. Yes, we have high interest rates pushing up the mortgage costs, but there's something more fundamental. Supply is severely constrained by zoning laws and land use restrictions. Take Canada, for example. They need about 5 lakh new homes every year just to keep up with the demand. But for the past 2 decades, they've only been building about 1.5 to 2.5 lakh houses annually. Here's another unique aspect. Unlike previous economic downturns where housing markets typically weakened, housing prices actually surged during the COVID-19 recession. Even as central banks started raising interest rates to fight inflation, prices haven't fallen nearly as much as experts had predicted. But there's also a darker force at play. Literally. You see, criminal networks and corrupt politicians are using luxury real estate to park illicit wealth, especially in cities like New York, Miami, London, and Dubai. In London alone, foreign companies held £73 billion worth of properties in 2018, with 90% of these purchases made through tax havens. This has sparked a global backlash against foreign buyers. Australia just tripled fees for foreigners buying existing houses. New Zealand banned foreigners from buying some residential properties back in 2018, and Canada has extended its foreign buyer ban to 2027. Even Singapore, traditionally welcoming to foreign investment, doubled its stamp duty on foreign buyers to 60%. Now, let's look at what's happening here in India. A report by real estate portal Magic Bricks shows the market's price to income ratio has hit 7.5, well above the globally accepted level of 5. Price to income ratio basically tells us how many years of our annual income it would take us to buy a house. Ideally, this number should be 5 or below. Even more worrying Indians are now spending about 61% of their income on housing payments. That's way above the 50% threshold that's considered sustainable. The impact varies dramatically by city. While places like Chennai, Ahmedabad, and Kolkata remain relatively affordable, with residents spending about 41 to 47% of their income on housing, in Mumbai's metropolitan region, that number shoots up to an impossible 116%. Delhi isn't far behind. It's at 82%. There might be some relief ahead though. The Magic Bricks report suggests a deceleration in price growth in coming years as supply levels increase. Plus, strong economic fundamentals and improved global growth prospects might lead to a slight reversal in interest rates. But fixing this isn't just about waiting for prices to fall. Experts say we need to address structural problems like removing regulatory barriers, targeting support for low income households, and rethinking zoning laws that restrict housing supply. As Alan Kohler puts it, it's a global housing affordability crisis, but each country is unhappy in its own. Now, on to the next story. OPEC Plus, the alliance of 23 oil producing nations led by Saudi Arabia and Russia, has made two big moves that could shape the energy market in 2025. First, the group decided to delay plans to increase oil production. They had previously announced a 2.2 million barrels per day, that's BPD, production boost starting in January 2025. That has now been pushed to April. Second, OPEC made its sharpest revision yet to its global oil demand forecast for 2024. They now expect demand to grow by just 1.6 million barrels per day, down from the earlier projection of 1.81 million barrels per day. This marks a 27% cut in their forecast since July, reflecting the challenging conditions the oil market faced throughout 2024. To understand the significance of these decisions, let's take a look at where the global oil market stands at the end of the year right now. The world is consuming around 101 million barrels of oil daily in 2024. OPEC expects this to increase to an average of 103.8 million BPD in 2025, with a peak of 105.5 million BPD in the final quarter of the next year. However, the pace of this growth is slowing down significantly. Despite production cuts totaling 5.8 million BPD, or roughly 6% of the global daily demand, oil prices haven't really surged. Brent crude, the global benchmark, is trading at around $73 to $74 per barrel, a far cry from $80 to $85 range that countries like Saudi Arabia need to meet their budget goals. The delay in increasing production and continued output cuts are OPEC's way of responding to market realities. This year, demand for oil has been weaker than expected. China, historically a key driver of global oil consumption, is struggling with an economic slowdown. Manufacturing activity has been sluggish, consumer spending has been lackluster, and oil imports haven't picked up as anticipated. In the US and Europe, high interest rates have slowed economic activity, further reducing the demand for oil. Even in emerging markets like India, demand growth has been steady but not strong enough to offset global weakness. Adding to OPEC's problems is the growing supply from non-OPEC countries. The US, now the world's largest oil producer, has been pumping oil at record levels, effectively neutralizing the supply cuts by OPEC, which they had implemented since 2022. Countries like Brazil and Canada have also ramped up their production. OPEC Plus is now stuck in a tricky spot. They need higher prices to support their economies, but increasing production could flood the market and send prices even lower. By keeping supply tight, they're trying to stabilize prices while protecting their market share. At the start of the year, the outlook seemed brighter. OPEC initially projected robust demand growth of nearly 2 million BPD, driven by reopening China and recovering global economies. But those expectations have steadily eroded. China, which contributed over 60% of global oil demand growth in the last decade, faltered in 2024. Sluggish factory output and weak demand in petrochemical sector weighed heavily on oil consumption. The situation wasn't much better elsewhere too. Europe faced economic stagnation, and the US saw slower than expected growth due to rising borrowing costs. Higher interest rates globally curbed economic activity, reducing the need for energy-intensive industries and transportation. Meanwhile, the long-term shift towards renewable energy and electric vehicles is starting to impact oil demand. Electric vehicle sales surged in 2024, particularly in Europe and China, eating into gasoline demand. While this transition is gradual, its effects are becoming increasingly evident. In theory, OPEC cutting supply should lead to higher prices, but in practice, the market has been balancing itself through a combination of factors. First, non-OPEC production has surged. US alone is producing at record levels and Russia has managed to maintain exports despite sanctions. This additional supply has offset much of the impact of OPEC's cuts. Second, demand growth has been underwhelming. The weak global economy has softened the need for oil, particularly in transportation and manufacturing. And finally, traders are afraid of betting on higher oil prices. The International Energy Agency has forecasted a potential oversupply of 8 lakh BPD by 2025, driven by increased production from non-OPEC countries. This bearish outlook is keeping prices in check. For oil importing countries like India, the implication of OPEC's decision are significant. If supply remains tight and prices rise, consumers will feel the pinch through higher fuel costs. This could also push up inflation, impacting everything from transportation to food prices. On the flip side, if global demand continues to disappoint and prices stay low, countries like India could benefit from reduced import bills. But the broader picture is more concerning for OPEC. Their influence over the market is being tested. With demand growth slowing and competition from non-OPEC producers increasing, OPEC faces a tough battle to remain relevant in this changing energy landscape. And now, on to the tidbits for the day. First, Jubilant Bhartiya Group is acquiring a 40% stake in Hindustan Coca-Cola Holdings for around 12,000 crores. HCCB, which saw a 10% revenue growth to 14,000 crore in FY24, aligns with Coca-Cola's divestment strategy and Jubilant's diversification goals, signaling a potential public listing. Number 2. Google's Gemini 2.0 AI model offers a 9% performance boost over its predecessor, introducing advanced AI features. This positions Google to challenge Microsoft and OpenAI in the AI race, catering to businesses with cutting-edge multimodal capabilities. And finally, US inflation rose to 2.7% in November, with core CPI remaining sticky at 0.3%. While a Fed rate cut is widely anticipated, stubborn inflation complicates the path for sustained monetary easing. And that's it for the day. I'm your host Kashish Kapoor. This was the Daily Brief, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.